Welcome to the deep dive. What if the secret to consistent profits in the relentless world of financial markets wasn't really about luck or intuition, but maybe a disciplined, repeatable process?
That's the million-dollar question, isn't it?
It really is. Today, we're cutting through some of the noise that traps, well, frankly, a lot of amateur traders. Those who often operate on impulse, maybe hope or social media hype. They end up becoming, as one market veteran bluntly put it, a cash cow for the millionaires and billionaires of this world.
It's a stark reality for many. The amateur often just feeds the machine, really struggling to cross that huge chasm to consistent profitability.
That's a tough truth to face, isn't it? But here's where the professionals, the successful traders, they flip that script entirely.
Ah.
They operate on process, not guesswork. And in this deep dive, we're going to unpack what might be the single most critical tool in their arsenal: the trading journal.
The journal, yes.
And this isn't just, a simple log of wins and losses. It's actually a comprehensive feedback system. Think of it as your personal database holding the key to unlocking your unique competitive advantage.
Absolutely. It's about transforming that raw experience into useful data.
So we'll explore the philosophy behind it, dissect its essential parts, uncover how to really extract actionable intelligence from it, and even see how market legends have used this exact tool to build their empires. This is basically your shortcut to understanding the true power of self-analysis in trading. Let's jump in.
Great, because really the fundamental shift separating amateurs from the pros starts right here with this understanding. Long-term success in the stock market has, well, frankly, nothing to do with hope or luck.
Nothing at all.
Well, not in the long run. As the legendary trader Mark Minervini stated, winning stock traders have rules and a well-thought-out plan. It's systematic.
So it's about replacing that kind of intuitive, sometimes chaotic gut feel approach with a structured system. And the journal then becomes like the central feedback loop in that system, enabling real data-driven decisions.
Exactly. Because without good records, how can you truly measure your performance or learn from your mistakes?
Yeah.
Dr. Alexander Elder emphasizes this constantly. He asks, if you do not have good records, how can you measure your performance, rate your progress, and learn from your mistakes?
Makes sense.
The journal gives you the objective data. It helps you identify what actually works for you, what doesn't, and crucially, why.
Okay, so when you talk about a well-thought-out plan, where does a serious trader even begin? That sounds daunting.
It often starts with defense. Actually, think about Paul Tudor Jones, the hedge fund giant.
Okay.
His paramount rule, the one he repeats constantly, is the most important rule of trading is to play great defense, not great offense. He's focused on protecting what you have.
Protect first, attack second.
Right. He famously begins each day assuming every single position he holds is wrong. Think about that mindset.
Wow, okay, so he's constantly questioning.
Constantly. And rigorously predefining exit points, like his famous 1% capital risk rule per trade. That kind of defensive approach, documented thoroughly in his logs, it's the bedrock of his long-term success.
And Minervini, you mentioned him earlier. He seems more aggressive, focused on growth stocks, but does he share that defensive mindset?
He absolutely does.
Yeah.
It sounds counterintuitive, maybe, but he prioritizes preservation of capital first and foremost. He emphasizes that not losing big is the single most important factor for winning big.
Because,
as he says, how much you lose is actually a choice you make. The market doesn't force big losses on you. Poor risk management does.
Ah, I see.
And the journal becomes that impartial record. It shows you precisely where you deviated from your crucial risk rules, maybe where you let a small loss snowball into a big one.
This really highlights a crucial point then. Trading isn't some kind of mystical art, is it? It's more like a performance science.
Very much so, like an athlete refining their technique over and over. A trader develops skill through deliberate practice. Most failures, honestly, aren't from flawed systems necessarily, but from simply not following a sound system's rules consistently.
Okay, and the journal provides the structure for that deliberate practice.
Exactly. It creates that structured scientific feedback loop. You start with a plan and hypothesis before you even enter a trade, logging your pre-trade thesis. Why are you taking this trade?
Right.
Then, during the execution and observation phase, you document what actually happens, prices, times, but also, importantly, your emotional responses. Were you anxious? Greedy?
Okay, the feelings too.
Absolutely. Then finally, in review and analysis, you compare your hypothesis to the actual outcome. Dr. Van Tharp noted this systematic review is the direct path to growing and improving. Every single trade becomes a data point in your ongoing personal experiment.
So it's basically the ultimate ego check. There's no hiding.
Pretty much, yeah. The journal forces the direct confrontation with the data, making self-deception, you know, almost impossible. It shifts that natural ego-driven question of, was I right? Which we all ask,
Yeah.
to the far more productive process-driven question, did I follow my plan? Mark Minervini himself talks about this crucial shift being key to his own journey to consistent profitability.
Okay, so moving from just logging trades to something more insightful. You mentioned turning raw activity into actionable intelligence. What does that look like? You said the journal needs to be more than just a simple diary.
Exactly. It needs to be let's call it a high-fidelity data capture system. It needs to record not just the numbers, but also the strategic thinking and the psychological state around each decision.
High fidelity. Okay, I like that. So what exactly goes into this kind of journal? What are the key dimensions we need to capture?
Well, I think of it in three critical dimensions. First, you've got the quantitative foundation. This is the what of the trade.
The hard numbers.
The hard numbers, exactly. Objective data points crucial for statistical analysis later on. You absolutely need to record things like the date and time, the instrument or symbol, direction long or short entry and exit prices, position size, your initial stop loss level, and maybe a nickel take profit level if you use one.
Seems thorough. Anything else quantitative?
Oh, yes. Don't forget trade duration and, critically, all commissions and fees. They add up.
Right, the hidden costs. Now, I've heard about one metric that really stands out for standardizing performance, especially when trade sizes vary. Is that the R multiple? And why is it considered so important?
Yes, the R multiple. It is indeed crucial. It simply expresses your final profit or loss as a multiple of your initial risk, the R.
Okay, can you give an example?
Sure. So let's say you decided to risk $100 on a trade. That's your 1R. If you end up making $300, that's a plus 3R win. If you lost $100, that's a minus 1R loss. If you lost $50, that's minus 0.5.
I see. So it levels the playing field.
Precisely. It allows you to compare a trade where you risked $50 to one where you risked $500 on an equal footing. It gives you a pure measure of your strategy's effectiveness, regardless of position size at that moment.
Okay, that covers the objective what of the trade. But you said a truly insightful journal goes beyond that into the why. How do we capture the strategic context?
Right, the strategic context. This provides the vital understanding for why a particular setup worked, or perhaps why it failed. It's the narrative behind the numbers.
So what goes in there?
You need to clearly document your pre-trade thesis. A simple statement. Why are you taking this trade? What's your edge here? Then your setup criteria. What specific predefined pattern or condition triggered your entry?
Like Minervini's VCP pattern you mentioned.
Exactly, like Minervini's volatility contraction pattern. Or maybe it's a Paul Tudor Jones style global macro catalyst, like a central bank announcement. Be specific. And absolutely critical, market conditions.
Ah, the bigger picture. So beyond just the chart pattern on that one stock, what aspects of the overall market should you be logging?
You definitely want to note the overall market trend is the S&P 500 trending up, down, sideways. What's the volatility like? Maybe check the VIX level. Is the sector or industry your trade is in strong or weak relative to the market? Even note correlations with other assets, if relevant.
Oh, wow. That's a lot of context.
It is, but it's invaluable. This level of detail helps you answer really important questions later, like, does my favorite breakout setup only work in low volatility uptrending markets? That specificity is where you find your real edge.
Okay, numbers, strategy.
Yeah.
Now let's get into what many traders, maybe even myself, tend to overlook. The how, the often squishy emotional and psychological side. How does the journal capture that?
Yeah, the squishy stuff. This is the psychological imprint, and honestly, it's arguably the most valuable component over the long run because emotions so often derail even the best laid plans.
So how do you log feelings?
You need to be systematic about it. Document your emotional and mental state at 3 key points. Pre-trade entry, what were you feeling as you put the trade on?
Yeah.
Confident, anxious, maybe feeling FOMO, fear of missing out.
Yeah. Okay, before you click the button.
Right. Then, during the trade, how did you feel as the trade unfolded? Were you calm, stressed, getting greedy as it went your way, tempted to move your stop?
Uh-huh. And after?
And post-trade exit? How did you feel when it was over? Relief, regret, satisfaction, frustration? Be honest.
That is truly fascinating. So you could literally track if, say, those trades you tagged with FOMO consistently end up losing you money.
Exactly. Dr. Brett Steenbarger, the trading psychologist, really hammers this point home. He emphasizes this awareness as the absolute first step to gaining emotional control. It reveals patterns like maybe anxiety leads you to exit winners, too early patterns you simply wouldn't see otherwise.
Okay, makes total sense. And one more element you touched on, visuals.
Ah, yes, for true visual forensics, chart screenshots. A picture is indeed worth, well, maybe not 1,000 words, but certainly 1,000 data points in trading.
Okay, so you'd capture screenshots. When exactly?
Ideally at the point of entry and at the exit. Maybe also grab a shot of a higher time frame chart for broader context.
And then you just save them.
No, you need to annotate them. Precisely mark your entry point, your exit point, your initial stop-loss level. Highlight any indicators you used, support resistance lines, the specific chart pattern you identified. Make it clear why you did what you did, visually.
I can see how that would build up over time.
It does. It builds a powerful visual library of your setups, both winners and losers. It also helps prevent hindsight bias, where you look back at a chart weeks later and convince yourself the setup was much clearer than it actually was at the time.
Guilty as charged sometime.
We all are, and annotations fight that. Plus, it actually helps build subconscious pattern recognition over time. For those looking for a practical way to tie this all together, structured templates, like the one referenced in our source material, are incredibly helpful for creating a consistent workflow.
Okay, so let's say you've done all this. You've got this incredibly detailed journal. It's bursting with data, notes, screenshots, emotional tags, but it's still just a collection of information until you actually do something with it, right? It needs to be, well, leveraged.
Precisely. That's the critical next step. A meticulously kept journal is essentially a dormant asset. Its true value, its power, is only unlocked through a disciplined, systematic review process.
This is where the raw data gets transformed.
Exactly. This is where raw data becomes actionable intelligence. This is where you sharpen your edge.
Okay, so what's the recommended rhythm for this review? How often should a trader be digging into their journal to really maximize its impact? You can't just let it pile up.
No, definitely not. Consistency is key here, too. There's generally a multi-tiered approach that works well. First, a daily review.
Daily. How long does that take?
It doesn't have to be long, maybe just 5 to 15 minutes at the end of each trading day. The main goal here is data integrity, making sure everything is logged correctly while it's still fresh in your mind.
Okay.
And it's also a quick mental and emotional check-in. Did you stick to your plan today? Did any emotions creep in? It helps you catch things like, say, revenge trading immediately before it becomes a bigger problem tomorrow.
Makes perfect sense. Catch it early.
Yeah.
And then, presumably, a deeper dive periodically.
Yes. Next up is the weekly review. This usually takes a bit longer, maybe 30 to 60 minutes, perhaps over the weekend when markets are closed.
And what happens in the weekly review?
This is a deeper analytical dive. You calculate your key performance indicators, your KPIs for the week. We'll talk more about those in a second. And you start looking for emerging patterns across the week's trades. What were your most common mistakes? Which setup was most profitable this week? Did your performance seem to correlate with specific market conditions that prevailed?
Okay, so identifying short-term trends in your own trading, and then for the really big picture strategic view.
That's the monthly review. Set aside maybe 1 to 2 hours for this. This is your comprehensive strategic assessment.
What are you looking for monthly?
You're looking at longer-term trends in your equity curve and your KPIs. Are you making progress towards your larger goals? This is where you make potentially major strategic decisions, like, do I need to completely eliminate a setup that's consistently losing me money, even if I like it? Should I allocate more capital or focus more time on a market environment where my stats show I have a clear, proven edge? This ensures your strategy evolves based on hard data, not just hunches.
It sounds like moving from that gut feel, that intuition, to concrete statistics is just a massive leap for most traders. What are the most critical KPIs, those key performance indicators you should be calculating to really quantify your performance objectively?
Yeah. Moving beyond, I think I'm doing okay, to, I know my exact stats. The first, most basic one is win rate, sometimes called batting average, simply the percentage of your trades that were profitable.
Okay, that seems straightforward.
It is, but be careful. It can be really misleading in isolation. You could have a 70% win rate, but if your few losses are huge compared to your many small wins, you're still losing money overall.
Ah, right. So win rate isn't the whole story.
Not at all. Far more important often is your profit-loss ratio, or average win, average loss. This compares the size of your average winning trade to the size of your average losing trade. A ratio of, say, 2.1 or higher, meaning your average win is twice your average loss, that really underpins long-term profitability.
That makes sense. Bigger wins than losses on average. What other metrics are essential?
Then there's the profit factor. This is simply your gross profit divided by your gross loss over a period. It gives you a single snapshot of overall profitability. Anything over 1.0 means you're profitable.
Right.
Professionals often aim for 1.5 or ideally higher.
Okay. Profit factor. Got it.
But arguably, the single most important metric, the one that really defines your edge mathematically, is trade expectancy.
Expectancy. Now, this is the one that tells you mathematically what you can expect to make or lose on average for every single dollar you risk on a trade.
Exactly. It elegantly combines your win rate and your profit-loss ratio into one powerful number. There's a formula for it. Win rate % average win in R. Loss rate % average loss in R. If you have a positive expectancy, congratulations. You have a mathematically defined edge in the markets. That's the goal.
That's the holy grail, finding positive expectancy.
It really is. And finally, it's helpful to visualize your performance distribution. Like, plot your R multiples on a histogram. This shows you visually if your profitability comes from lots of small wins, base hits, or just a few large ones, home runs. And crucially, it helps identify the devastating impact of those occasional large outlier losses that can wipe out weeks of gains.
Seeing it visually makes it real. Our source material apparently includes a table with these critical KPIs, which sounds like an excellent guide for anyone starting out.
Yes, it's a great reference.
So once you've got these numbers crunched, the next step is connecting the dots, right? The qualitative analysis. This is where you become like a detective with your own data.
That's a great way to put it. You're searching for the patterns behind the numbers, the context that explains why your KPIs look the way they do. You're isolating the specific conditions that lead to your best performance.
So what kind of questions should you be asking your data?
You need to get specific. Ask things like, which of my defined setups has the highest expectancy? How does my profit factor change when the market is strongly trending versus when it's stuck in a range? Are Mondays consistently my worst trading day for some reason? Do the trades I tagged with FOMO almost always result in a loss?
Okay, really drilling down.
Exactly. This deep questioning process helps you define your unique A-game, that specific confluence of a particular setup occurring in a particular market environment, executed with a disciplined mindset where you truly perform at your best. Then you can focus on trading mostly under those conditions.
And the flip side of finding your A-game is using the journal to diagnose and eliminate those unforced errors, right? The self-sabotage that often kills trading accounts.
Absolutely. So many losses, especially for developing traders, stem not from inherently flawed strategies, but from flawed execution, basically. Self-sabotage. The journal is the ultimate diagnostic tool for this.
What are some common mistakes it typically reveals?
Oh, the classics usually jump right out of the data in the comments. Overtrading and revenge trading often appear as clusters of rapid-fire trades right after a loss. Trades that often lack valid setups and are tagged with emotions like frustration or anger.
Been there.
We all have. Then there's style drift. You have a plan, but you start taking trades that don't really fit, maybe out of boredom or impatience. Minervini constantly warns against this. Poor risk management is huge, widening your initial stop loss because you hope the trade will turn around, or failing to cut losses quickly according to your rules.
And the big one.
And the big one, what some call the cardinal sin, averaging down. Adding more money to a losing position, hoping to lower your average entry price. That's a recipe for disaster, usually.
Mm-hmm.
The journal makes these patterns undeniable.
And the beauty is you can actually quantify the cost of these errors, right? Like
Yeah.
you could filter your results and say, wow, if I had just not taken those revenge trades last month, my P&L would have been positive. That's a powerful motivator for change.
Incredibly powerful. Once you see the financial cost quantified, it hits differently. Then you can create specific, actionable plans to address them. Not just vague goals like be less impulsive, but concrete rules like, after any loss greater than 1R, I will step away from the screen for 30 minutes to reset.
That seems much more effective.
Yeah.
Now, moving from the theory and the how-to to actual practice, it's fascinating to see how market legends, the real masters, actually apply these principles of self-review. Let's talk about Paul Tudor Jones again.
Right. His entire philosophy seems built on profound humility and defense. That core idea, assuming every position I have is wrong the moment he puts it on, acts as a catalyst for continuous real-time review.
So he's not just reviewing at the end of the day.
Yeah. He advocates for daily reevaluation of all open positions, using the current closing price as the reference point, not his original entry price. This prevents emotional attachment to where he got in. He's constantly asking, knowing what I know now, would I still enter this position today? His journal would reflect these ongoing assessments.
And that famous dynamic risk management rule he has, decrease your trading volume when you are trading poorly, increase your volume when you are trading well. That's pure data-driven decision-making, isn't it? Not emotional reaction.
Absolutely. It's directly informed by a constant review of his performance statistics, his P&L, likely tracked meticulously trade by trade in his records. And he genuinely believes, as he often states, you learn more from your losses. The journal is where that learning is codified.
Okay, and how about Mark Minervini, the super performance guy? How does review fit into his approach?
Minervini is incredibly explicit about this. He states unequivocally, analyzing your results is the single best thing any trader can do to improve their future performance. His entire SEPTA strategy, the specific entry point analysis,
Right, his system.
that was refined over years through the meticulous review of literally thousands of his own trades. He used his records to identify the precise fundamental and technical characteristics, the specific chart patterns that preceded the biggest stock moves. Those were his highest expectancy setups.
So the journal was essentially his R&D lab.
Exactly. And it also acts as his accountability partner. It enforces specialization on his high probability setups and helps prevent that style drift he warns about so strongly. It helps him cultivate the patience to wait for his A-game opportunities, because his data shows him exactly what conditions align with his edge. For him, truly, the ultimate trading coach is one's own performance data.
And what about Dr. Brett Steenbarger bringing in the psychological angle again? How does he view review?
Steenbarger focuses heavily on translating the insights gained from review into tangible behavioral change. He's big on moving beyond just observation.
So not just noticing, I get anxious, but
Right. He advocates transforming those observations from your journal into concrete, measurable goals. So instead of a vague goal like be less anxious during trades, a journal entry might reveal a pattern of moving stops too soon due to anxiety. That then leads to a specific goal like, for the next 10 trades, I will place my trailing stop order according to my predefined plan, and I will not touch it until it is hit or the trade closes.
making it actionable.
Very actionable. He also stresses the importance of balancing negative and positive analysis. Don't just focus on your mistakes. You should also actively review what you did right when you followed your plan perfectly, managed risk well, stayed patient. This reinforces good habits and builds resilient confidence based on process execution, not just recent P&L.
Which aligns perfectly with Minervini's idea of learning to lose correctly. That is, losing in a way that adheres to your process and minimizes damage, which is actually a sign of professional discipline.
Absolutely. And what's truly profound when you look at these masters, like Jones and Minervini, is the convergence.
How so? They seem so different.
Well, Paul Tudor Jones is a global macro trader, looking at currencies, interest rates, commodities. Mark Minervini is a growth stock momentum trader, focused purely on equities with specific characteristics. Their strategies for what to trade are vastly different. Worlds apart, really.
Okay.
Yet their fundamental processes for how to trade disciplined risk management as priority number one, and rigorous data-driven self-review enabled by detailed record keeping are nearly identical.
Wow. That is a powerful takeaway. So regardless of the market or the specific strategy.
Regardless, it demonstrates that the specific entry technique, while important, is almost secondary to the overarching framework of risk control and continuous self-analysis that the trading journal facilitates. That process seems to be the universal key to professional performance.
Okay, so we've thoroughly explored the why and the what of the trading journal and seen its profound impact through the lens of market legends. The final piece, and maybe the most challenging for many listeners, is actually doing it. Building that discipline engine, making journaling a consistent, unbreakable habit.
Yes, bridging the gap between knowing and doing. That's often the hardest part.
Because let's be honest, for many people, the idea of meticulous journaling after every trade can feel, well, time-consuming, maybe even burdensome, especially when you're busy or didn't have a great day. What helps overcome that inertia and make it a sustainable practice?
That's a very real hurdle. The first key is choosing your format. The absolute best journal is simply the one you will actually use consistently. There's no single right way.
So what are the options?
It could be a simple physical notebook if you're tactile and like writing things down. It could be a digital spreadsheet like Excel or Google Sheets, which allows for easy calculations and sorting. Or increasingly popular, especially for active traders, is dedicated journaling software.
Right, you mentioned those earlier, like TraderSync, TradesViz, EdgeWonk. What are the big advantages they offer? Why would someone choose those over a spreadsheet?
They significantly streamline the whole process, which is huge for consistency. Many offer features like automatic trade import directly from your broker, which saves a ton of manual entry time. They can auto-generate detailed performance reports and charts, calculating all those KPIs we discussed with just a click. Some even offer AI-driven analysis to help spot patterns you might miss. They lower the barrier to getting professional-level analysis from your data.
That sounds like a game changer for serious traders. What else helps build the habit?
Using templates and checklists is really key, regardless of your format. A standardized template, like the one we've implicitly discussed covering the quantitative, strategic, and psychological aspects, ensures you capture the same crucial data points for every single trade. Consistency is vital for meaningful analysis later.
And checklist.
A pre-trade checklist can be incredibly powerful. Before you even think about hitting the buy or sell button, you run through a short list. Is this setup on my pre-approved list? Does it meet all my entry criteria? Have I determined my initial stop loss? Have I calculated my position size according to my risk rules? It forces a moment of reflection and ensures adherence to your plan before emotions can take over.
A pause button, essentially.
Exactly, a structured pause button.
So let's pull back for a moment. What does all this meticulous tracking, review, analysis, and disciplined adherence to process actually build in the long run for a trader? What's the ultimate payoff beyond just potentially better P&L?
That's a great question. What it fundamentally builds is true, resilient confidence.
Not just feeling good after a win.
No, definitely not. That's fragile, ego-based confidence that evaporates after the next loss. This is different. This is a deep, data-driven belief in your process, built brick by brick, trade by trade, review by review. After analyzing hundreds, maybe thousands of your trades, you know your statistics. You know your system has a positive expectancy over the long term, even with losses along the way.
That data-backed confidence must be incredibly powerful, especially during tough periods.
It's everything. It allows you to weather those inevitable drawdowns and losing streaks with equanimity, with composure. You understand they are a statistical part of the business of trading, not personal failures. That emotional detachment from individual trade outcomes, rooted in the statistical strength of your validated process, is truly a hallmark of the professional mindset.
So the journal isn't just a record keeper, it's a confidence builder based on proof.
Absolutely. And ultimately, your journal becomes your ultimate trading coach. Think about it. It's a personal mentor that knows your trading better than anyone. It's an unbiased statistician, showing you the cold, hard facts. It's even an on-call psychologist, reflecting your emotional patterns.
That's a powerful combination.
That hold you accountable like nothing else can. It reflects your true strengths and weaknesses with unflinching honesty. And it provides personalized insights that no guru, no book, no course can ever offer because it's based entirely on your unique performance data. The path to elite performance in trading or any performance field is paved with data, and the journal is the central tool for navigating that path.
When you put it that way, the contrast between the disciplined trader who embraces this meticulous self-analysis and the undisciplined one becomes incredibly stark, doesn't it?
Night and day. The disciplined trader, using their journal, focuses on flawless execution of their validated process, knowing that consistent profits are the byproduct of good process. They accept losses quickly as a business expense, learn from them via the journal, and view that review as indispensable.
Whereas the undisciplined trader...
The undisciplined trader is constantly chasing the P&L, letting ego and hope drive decisions, praying for losing trades to turn around, maybe avoiding looking at their results and viewing journaling, if they do it at all, as just a tedious chore. The results are predictably different. Consistent, methodical capital growth over time for the professional versus erratic, stressful, and often ultimately ruinous outcomes for the amateur. It really poses a powerful challenge for you, the listener, to honestly assess which path you're currently on.
So wrapping this up, what does this deep dive into the trading journal really mean for you listening right now? We've hopefully made it clear that the trading journal isn't just some administrative chore or an optional nice to have. It is arguably the single most critical instrument for self-discovery and self-mastery in trading.
It's the mechanism that transforms speculative impulse into a disciplined, data-driven business.
And think about this. If the world's most successful traders, people operating at the highest levels, from global macro legends like Paul Tudor Jones to growth stock superperformers like Mark Minervini, if they all converge on one universal process for achieving and sustaining success, which involves disciplined risk management and rigorous data-driven self-review through journaling.
What might embracing that same level of meticulous self-analysis do for your performance? not just potentially in trading, but perhaps in any high-stakes, skill-based endeavor you pursue, where objective feedback is paramount.
It raises a really important final question for you to consider. What untapped insights, what hidden potential is currently waiting to be discovered in your own data?